Okay, everybody, how we doing today? Good. Good, thank you. We had some good news from one of our students if they want to share. I won't put anybody on the spot. I am indeed. Congratulations. And you met them here at the last career fair. So worth going to. Good job. We're proud of you. All right. Now we got some practice questions that you guys have up there. And I'll go through them in about 3 minutes. It should be, it's the same one that we, or no, hold on. Should be handout 18. I think it was. I might not have put it up there. Thought I did. Bless you. Sorry about that. It is now up there. You're welcome. Okay, so let's go ahead and take a look at these questions. A liability for compensated absences, such as vacations, for which it is expected that employees will be paid should, and this is just like our matching, we want to try to match and record expenses when they occur in the period. So be accrued when the period is when they're earned. Which of the following does not represent a common employee payroll deduction? That's state unemployment taxes. Which one of the following is an example of a contingent liability? And so this would be obligations related to a product warranty. Receipt wouldn't be contingent liability, right? Pending court case with a probable favorable outcome. Again, you wouldn't worry about that. and tax loss carry forwards are something completely different. Okay. Martinez Co. has a loss contingency to accrue. The loss amount can be only reasonably estimated with a range of outcomes. No single amount within the range is a better estimate than any others. The amount of the loss accrual should be the minimum of the range. In a service type warranty, warranty revenue is recognized equally over the warranty period. And that's like an extended warranty for a couple of years. When the other warranty expires and that warranty kicks in is when you start recording it. Assume that a manufacturing corporation has good quality control, a 1-year operating cycle, a relatively stable pattern of annual sales, and a continuing policy of guaranteeing new products against defects for 3 years. That has resulted in material but rather stable warranty, repair, and replacement costs. Any liability for the warranty to be reported as long-term. No, that's not correct. They're going to have to pay some of that out in the next year, should be recorded as current. That is true, but the correct answer here is both should be reported as part current and part long-term. So the answers are C, A, B, D, and C. Any questions? Okay. All right, so we're going to talk about some of the liabilities. And so we're going to talk about what they are, and then also the entries. Okay. Income taxes payable are taxes expected to be paid within one operating period, cycle, or year. Keep in mind, companies are required to pay quarterly into the IRS. When a company pays the IRS quarterly, it records debit to income tax expense. I'm sorry, income tax payable. My apologies. And a credit to cash. So the government doesn't like to wait for their money. So we as individuals, whenever we have pay, the company takes income taxes out of our salary, and then we figure it out at the end of the year whether we've taken out enough or whether or not we need to take out more and pay more at the end of the year. And if you're too off on your estimate, the IRS will penalize you with both fees and interest. It's the same way for corporations, except for they have to make quarterly payments. So at the end of each quarter, they'll make payments. And so you'll notice this entry looks a little bit odd. How often do we debit a payable? Well, when we pay it. So this kind of creates a problem in that we are paying this all throughout, let's say 2024. When do we actually know what our taxes are? It probably way into next year, right? So we've already filed our financial statements with all of our financial information. And that's why you don't have actual tax return information on your financial statements, because your tax expense is our best estimate given what's reported in the financial statements. So that's not really a true tax expense. on the financials until you see the actual tax return. That's your true tax expense. But we end up not truing this income taxes payable account up until October next year. So you'll have 6 to 7, 8, 9 payments made already to true this up. So whenever you look at the income tax payable account, just keep in mind that it's weird and it operates, kind of far into the future for some of our other expenses. But at the time, we are going to have probably a negative income tax payable during the year. Okay, and then, so then when taxes are calculated using the Internal Revenue Code, then they'll report a debit to income tax expense and a credit to income tax payable. Okay, now we're going to talk about some employee-related liabilities. So employee-related liabilities are liabilities that result from taxes or other payments withheld from payroll. These are the employee-related liabilities. So these are what the employee is responsible for. So all liabilities are recorded by the company because they hold the funds, right? So they're part of their payroll expense and they withdraw it from your pay and have to pay it to the specific entities. What are some of those that employees are responsible for? So federal income tax, state income tax, healthcare, long-term compensation, like savings compensation. This would be like 401k or 403b withholdings. And then 1/2 of FICA, which is like Medicare, Social Security, and unemployment. I should say federal unemployment. So if you are a contractor, like you work for Uber, you work for DoorDash, you are not treated like an employee. So all of these taxes are yours to have to pay. So hopefully when they're paying you enough to pay these things and still make a decent living. Now, we know that's likely not to be true, except for in a few places here in the United States. But that's the way it goes. So at the end of the year, you would have to file a self-employment form, and you would have to actually pay, instead of half, if you are your own employer, you pay all of that. So keep that in mind. Right now, your employer is picking up half. If you ever go to contractor or you're self-employed, approximately 15% right off the top goes to Social Security and Medicaid. And so you got to make sure you price that in when you're doing your jobs. So let's see, where am I? And so the entry would look something like debit to payroll, or what's it, wages and salaries, expense. And then you'd have a credit to employee healthcare payable. Another example would be employee 401k payable, something along those lines. Okay. Now, employers, they have a payroll tax responsibility that they're for, and they'll usually pay state unemployment. And they usually get a credit for this versus federal, so that they're not double charged for it. And then they pay the other half of FICA. And so for this entry, they would debit payroll tax expense and credit FICA payable. And then maybe a credit for state unemployment. So keep in mind when you're doing these, income tax withholding, FICA taxes, you have the employee share, they pay for it. Things like union dues, health insurance, any of their long-term for like defined contribution plans. Yes.
When your employer is paying those what happens to that?
That money is put into the Social Security and Medicaid trust. So you don't get any of your FICA or Social Security back until you retire, presuming it'll be there when we're all nearing that age, right?
So they pull it even though you don't.
They still will take it out, Social Security and Medicaid charges, but your income tax, they have the choice to do that. So most of the time, if you are going to be under that number for a year, and I can't remember what it is off the top of my head, I think it's like 12,000 for an individual filing a loan, 4,000 for a dependent. It could be a little bit more, but it's somewhere in there. And so essentially, you don't have to file that. So they should not take any taxes out of your pay, but not Social Security and Medicare. Those you have to pay no matter what. But income tax, you won't have any.
So even though I don't file, but
You would still be responsible if you were a contractor, single, for paying your Social Security taxes. Yes. Now, will you get beat up for it? Probably not. On something small, they'll probably never notice it. And I'm not saying that's the ethical way to go. But the other part is too, is that you're not paying into that Social Security, so that won't count towards you getting paid out. Ideally, you should, but it's not something that they're chasing around small earners for. But if you're a big earner, then you better make sure that you pay it. Okay, let's take a look at example 1. So it says it has a taxable payroll of 1.2 million, is subject to FUTA tax of 6.2%, and that includes a state contribution rate of 5.4%. However, because of stable employment experience, the company's state rate has been reduced to 2%. So federal government gives a break on the state unemployment up to 5% as of, I think it was 2023. Sorry, 5.4%. Even if this isn't fully paid to the state. So the federal government still gives the business a credit for 5.4%, even if the state has decided that they only need to collect 2% of you because your company doesn't lay off people. It doesn't have a bunch of people claiming unemployment. So here, the amount to federal would be 1.2 million multiplied by the 6.2% minus 5.4%. Let me put percent signs on there so you don't go back and go, man, his math is way off. And so that's 1.2 million times 0.8%. So that's 96,000. And to the state, it's 1.2 million times 2% because they had the adjusted rate. That's 0.08. I made a math error there. That's 9,600. Because that should be 0.08%. Okay. And then let's see if I can do this one correct this time. 1.2 million times 0.02, and that's 24,000. So 24,000, we add state and federal because it asks for both. And we get 33,600 for letter D. I got a little 30-second practice one for you. Okay. So it says an employee's net or take-home pay is determined by gross earnings minus the amount for income tax withholdings and the employee's portion of FICA taxes and any union dues. So that's letter D there. Okay. Any questions before we jump to compensated absences? So what are compensated absences? They can be sick days, vacation days, holiday pay, any type of time that you earn. Sometimes you'll hear it called paid time off. That's what we're talking about here. And compensated absences should be accrued when all of the following conditions exist. Okay. The service by the employee has already been rendered. The obligation is vested or accumulated. So a lot of companies will limit your paid time off. It needs to be able to accrue beyond a certain point if they want to still continue to record it. So it has to be yours and it has to be able to accrue or accumulated. So some companies won't pay after anymore and they make you take your time off. And that's where you could run into a ceiling on this type of thing. And you'd say, well, why wouldn't it be vested or accumulated? Because you didn't take your time and so it's getting burned, for example. Number 3, payment of the compensation is probable. So this one's a little weird to me because there's kind of a fundamental thing that we have in accounting that we expect for all of the companies that we're preparing financial statements, and that they're going to continue as a going concern forever. So here we have a liability and it says the payment of compensation is probable. I can only think of like some startup companies that might set compensation above what they think they can pay, and they know, if we don't hit this mark, we're gonna have to fold up. But most companies, the expectation is you pay your liability. So this one's a little weird that it shows up there, but it is one of them, and the amount can be reasonably estimated. And that's important. If they have a range, like I said, they'll pick the one that's most probable within that range. If there is none most probable, you accrue at least the minimum. Let's take a look at example number 2, and I'll walk through it. Take about 30 seconds to read it carefully. Okay. So it says a company gives 75 employees, assume they were all employed the full years for 2020 and 2021, vacation, 12 days starting the next year. The employees worked 8 hours per day. In 2020, they made 21 per hour. And in 2021, they made 24 per hour. During 2021, they took an average of 9 days of vacation each, which will leave us 3 days from 2020 left over in 2021. The company's policy is to record the liability existing at the end of each year at the wage rate for that year. So this is going to throw a little monkey wrench in the works for us. And I'll explain to you why, because some of our questions as we go on are slightly different. And it's just the way that they word them. What amount of vacation liability would be reflected on 2020 and 2021 balance sheets respectively? So for 2020, it's fairly easy because there were none taken, none of the vacation days. So all you have to do is take the 75 employees, multiply that by 12 days vacation, by 8 hours, by 21 per hour, and you end up with 151,200. For 2021, we have 75 employees times 12 days times 8 hours times $24 per hour. Why is that so much shorter? Sorry, my brain is weird. All right. And so we end up with 172,800, plus we have to add the remaining for 2020. Note that the question says use the wage rate for the year. Okay, so for 2020, you have 75 employees times 3 days, because that's all they have left over, times 8 hours. And we're gonna go to the new compensation, so $24 per hour. And I'm gonna make a note here. Most of the time, the new pay is not used for older accruals. Which means if it was accrued in 2020, we would not adjust it. 2021 pay rates. So then we multiply this amount out and we end up with 43,200. And so 172,800 plus 43,200 equals 216,000. So our answer here is C. Any questions? Okay, now you've got 2 of your own to practice on. So you can just do practice number 2 here. What amount of the expense relative to compensated absences should be reported on the income statement for 2020? And I'll give you about 3 minutes to do that, and then I'll talk about the answer. And you guys can talk amongst yourselves. If you have questions, you can raise your hand. I will come over to help. So if you're not sure how to get started, just kind of wave your hand over. I want you to try these. Talked to the admins and they said, I can't hook you up to a defibrillator if you guys don't have anything written on your paper and you refuse to write. But I did ask. It's one way to get them working. I'm on camera and I can't talk about it. Does remind me, I can bring in a dog collar. I've got one of those shocking ones. Okay, so this one is pretty straightforward. 2020, they want to know what should be on the income statement for 2020, and we can see that they didn't use any vacation days, so all they did was accrue them. So we would have to make the accrued entry. So they have 70 employees. Sorry, that's not the right size. They have 70 employees multiplied by 8 hours per day. And 10 days per year. And so that should equal 114,800. Sorry, I forgot to put in the pay rate there, right? 20.5 per hour, because this one says that Vanco has chosen to accrue the liability for compensated absences at the current rate of pay at effect when the compensated time is earned. So this is slightly different than the last question in that we're going to keep our rates going forward. Okay. So this one's a little more challenging. I'll give you guys about 5 minutes to do it. What is the amount of the accrued liability that should be reported at December 31st, 2022? So at the end of 2022. How you guys feel about this one? Darn it. At least you tried a couple ways. That's all I can ask for. All right, so it's asking what is the amount of the accrued liability for compensated absences that should be reported at December 31st, 2022. So here we're looking and saying, okay, what's happened at the end? So originally we accrued 30 days and they took 18. So accrued 30 days, employees took 18 days. So now that leaves 12 days remaining, 2 from 2021 and 10 from 2022, right? So we essentially use first in, first out, right? So for 2021, we have 2 days times 70 employees times 8 hours times, what's it, 22.5? 22.5. And so that equals 25,200. And then for 2022, you have 10 days times 70 employees times 8 hours. And their pay rate is 25. And so that equals 142,800. And so the total accrual is 168,000. Does that make sense now after you tried those multiple ways? Not to pick on you. But I want to make sure that that makes sense. So they used all their days from 2020. They used 8 of their days from 2022 or 2021. And that's what's left over.
Yours.
Yep. Oh, thank you. No, it's always good to double check me. So you guys know what bonuses are, the entry to record bonuses, be a debit to salaries and wage expense, and then a credit to cash or salaries and wages payable. It's not treated any different than regular wages. Another practice question for you to do. Okay, so the currently maturing portion of long-term debt. So if you're making payments on an automobile and you're going to be paying it for the next 5 years, 4 years of payments are going to be long-term. Your next year is going to be current. And so the portion so classified will be liquidated within 1 year using current assets. Why do we care about appropriately classifying them between current and long-term? Because investors want to know what you have to pay coming up this year and they want to look at your current liabilities. So if you're moving liabilities out towards long-term debt, investors think that you have less coming due this year. Now, there are cases where short-term debt can be treated as long-term, and that's if you have an agreement to refinance it or a plan to refinance it in the works. When the balance sheet closes, they'll give you credit for that. We're all familiar with unearned revenues, hopefully. And so Let's talk about something like gift cards, which they cover. And your debit would be to cash. Your credit would be to unearned revenues. Gift card. And so companies estimate the value of gift cards that are never redeemed. So a certain portion of gift cards is never going to be redeemed, and they're going to call that breakage. And they do that and get to record revenue during the year. And so they would debit unearned gift card revenue. And they would credit revenues. And they would call it gift card breakage. Now, in some places, you cannot write off the gift cards. The gift cards are good forever. It varies by state. Let's take a look at example 3, Rio Grande Taco Palace. Ooh, sounds exciting. Sells 200 gift cards at $50 per gift card, and 100 of the gift cards are redeemed by year end. Prepare the journal entries. Ignore cost of goods sold, and possible breakage. Okay, so we have cash, and that's 200 times 50, or $10,000. And then we have unearned revenue, gift card, for 10,000. And then they redeemed a portion of them, so unearned revenue for gift cards. And that would be 100 times 50, 5,000. And the credit goes to revenue gift card for 5,000. Okay, let's take a look at example 4. Refer to the facts in example 3. Rio Grande estimates that it will have a 10% breakage on its gift cards. Prepare the entry for the gift card redemption and the expected breakage for the gift cards in the current year. Breakage on 200 cards equals 200 times 10%, which equals 20 cards. Remaining 180 cards to be redeemed. So take a portion of that total to get your percentage. Of revenue to recognize. So we had 100 cards redeemed. Divided by 180 cards expected to be redeemed. And that equals 55.55%. And so we would do unearned revenue for our gift cards. And that would be 100 times 0.555. And that equals 5,555. You have sales revenue of 100 times 50. And so that's 5,000. And then you have sales revenue breakage of 555. Any questions? They talk briefly about it, but if the company intends to refinance short-term debt, then you can leave it classified or reclassified as long-term debt. And so the company must intend to refinance the obligation, and the company must demonstrate an ability to consummate the refinancing. Additional reasons to classify long-term, to classify to long-term, excuse me. The liability is contractually due to be settled more than 1 year. So it's pretty straightforward, right? We know that. And the entity has a contractual right to defer the settlement of liability for at least 1 year after the balance sheet date. So that would be, for example, if they said your note payable is due in 6 months, but you have an option to renew it for another year. So that would be an example like that occurs. Okay, let's take a look at example 5. Okay, so Jump Corporation has $3 million of short-term debt. It expects to retire with the proceeds of sale from 85,000 shares of common stock. If the stock is sold for $25 per share, and this is where they say, subsequent to the balance sheet date, but before the balance sheet is issued. So management can argue at this point, we had these plans, it took some time for it to settle. Once we get this cash, we're going to reduce our cash balance, and we're also going to reduce our short-term debt by paying that off. So here, they're allowed to reduce cash and short-term debt. And so one of the best ways to get evidence of something happening is we come in an audit in January, right? Usually at the end or the beginning of February. So we should see this transaction that closed. And so we should see that they actually did this. We should see the payment on debt. We should see their cash come down. And so if we don't see that, we don't consider it happen. But if we consider it happen, then we can go ahead and allow them. And so it's 85,000 shares multiplied by $25 per share. And that equals 2,125,000. So that answer is B. Okay. Now, we started to get away from the things where I kind of learned to be recording warranty expense and things like that. Now they'll call them loss contingencies. And what they do is essentially for anything that you have a loss, potentially you may have to record it. So loss contingencies involve possible losses, a liability incurred as a result of a loss contingency is by definition a contingent liability. The contingent liability depends on some future event occurring or not occurring. The likelihood of a loss. So when a loss contingency or contingent liability exists, likelihood of the event occurring can range from probable to remote. And so here the FASB uses the terms probable, reasonably possible, and remote to identify 3 areas within that range and assigns the following meanings. So probable, the future events are likely to occur. Reasonably possible, the future events occurring is more than remote, but less than likely. And remote, the future events occurring are slight. That's not good English. So I gotta put likelihood of future events occurring. Is slight. So what we have to do is we record contingent liability if it is probable and estimable. So let's take a look. Scorsese is involved in a lawsuit at December 31st, 2025. Prepare the December 31st entry, assuming it is probable that Scorsese will be liable for $900,000 as a result of this suit. And so put that in there as lawsuit loss because it doesn't tell us exactly where it would go or if it was part of operations or something like that. And we have lawsuit liability for 900,000. And so now it says for part B, prepare an entry, if any, assuming it is not probable that Scorsese will be held liable for the payment as a result of this suit. And so there would be no entry required. No entry required because it's not probable. Okay, warranty costs. So a warranty product guarantee represents a promise by a seller to a buyer to make good on any deficiency or quantity, quality, or performance in a product. So there's two types. We have an assurance type warranty. This is something that we get with all of our products, doesn't cost any extra. And we agree that it meets the agreed upon specifications in the contract. So the product that you bought is supposed to work for its intended purpose. The service type warranty is sold separately from the product, usually an extended warranty. The service type warranty is recognized over the life of the warranty, and the assurance type warranty, we only we don't do any recording except for the recording of the expense for the warranty. So let's take a look at example 7. Leopard Corporation sells smart home systems. The corporation offers its customers a 4-year warranty contract. During 2025, Leopard sold 20,000 warranty contracts at $90 each. The corporation spent $180,000 service warranties, servicing warranties during 2025. Prepare Leopard's journal entries for the sale of the contracts, the cost of servicing the warranty, and the recognition of any warranty revenue. Assume service costs are inventory costs. So that means they're going to be taking the expense out of inventory. So here we have cash that we received, and this is 20,000 times 99, and that's 1,980,000. And so this would be unearned warranty revenue. 1,980,000. And here for B, the cost of servicing the warranties. So we have warranty expense. And then this is where they tell us that at the service costs are inventory costs. So we are going to take items from our inventory and reduce our inventory balance, 180,000. And then C, we have to look at what portion of the revenue that we're recognizing. So we're going to eliminate some unearned warranty revenue. And we're going to record warranty revenue. And we don't really know exactly how it's breaking down. So the only thing that we can do is just use kind of a straight line method. So we divide that by 4. And we end up with 495,000. Okay, and then the last part just describes the presentation for the balance sheet. And it also shows the current ratio and the acid test ratio. Keep in mind the current ratio. This is why it's important that if you can move those assets out you have a smaller, or excuse me, if you can reduce your short-term debt, you have a smaller numerator, okay? And so that makes your current ratio higher. So that's why a company like that would want to create something to reduce their short-term debt by selling investments. Now, the acid test ratio is also included. And what it does is it takes out inventory, because inventory is hard to change to cash quickly. And so the acid test ratio just says, what kind of cash do you have available quickly that you can use to pay down debts? That is it for today, but I am going to pass out the Chapter 12 team problem. So for those of you that are online, this will be due on Thursday. You have like 9 minutes in this class, so I'll give you guys like 25 minutes in the next class to work on this. But you'll want to talk about it, and if you have any questions, please let me know. Otherwise, you are free to go for today. Thank you, and I appreciate you.